Okay, so you guys can hear me, right? No issue in my voice, or you guys can see my screen.
Yes, sir.
Okay, so I want you, since we have only two students, right? So I want you to participate in the class as much as possible. Okay, both of you.
Okay, sir.
Okay, now tell me, have you completed or even studied cash flow statement at least once previously?
Yes, sir.
Okay, because I think this is a 12th class concept also, and if you have completed, it's fine. So if you know, please answer as much as possible. Okay. Okay, so let's start. So we are talking about cash flow statement, and this is one of the financial statement which is mandatorily we have to prepare. So according to companies law, there are financial statements, right? So we need to prepare trading account, we need to prepare P&L account, we need to prepare balance sheet. Along with that, we need to prepare cash flow statement also. Of course, there are some companies, like for example small company, doormat company, they don't need to prepare any cash flow statement, but every company has to prepare the financial statements, and then these financial statements include balance sheet, P&L account or income and expenditure account, and cash flow statement. Okay, so cash flow statement also is the one of the financial statement which a company has to prepare mandatorily. And who has to prepare, who don't need to prepare, this is mostly law part. We are not going to discuss anything related to the law part. Okay, we are going to discuss everything related to the accounting part. Now answer me some basic questions like before going to the cash flow statement, because again if you don't know the basics we cannot solve the cash flow statement questions. So even though some people may just know the format, they just keep on doing the same thing and again, and in the exam they are not going to give the same question, they are going to give one or two adjustments like which are a little bit difficult, right, or which are new. So because of that one or two adjustments, your entire answer will get, or at least 70 to 60% your answer will be wrong. So that's why we have to discuss everything properly. Now tell me, are we going to prepare, normally do we follow accrual basis or cash basis? Do we follow, while preparing the books of accounts,
Cash
do we
basis.
follow accrual or cash basis?
Cash basis.
Confident? Are you guys sure? Now, what is the difference between accrual basis and cash basis? Tisha, what is the difference? Any idea? Yes or no?
No, sir.
Okay. So, see, basically, cash basis means we will record all items like like expenses, income. We will record a transaction when it is in cash basis. That means whenever the cash is going out, we will record it. Whenever the cash is coming in, we will record it. That means if the transaction is not in the cash basis, we don't record. What does that mean? Let's just say sold goods to Ram on credit basis. Now is it a cash transaction or credit transaction?
Credit.
Credit transaction.
Obviously credit transaction. Is there any cash involved in this transaction?
No.
No. If you are following cash basis system, you don't record this transaction at all. You won't record this transaction at all. So, but we want to record everything, right? If you don't record this transaction, so whenever let's just say this has happened on January 1st, and then later January 10th, cash received from Ram. You will record this transaction because cash is involved. This is a cash transaction. So if you do like this, what will happen? This data, this transaction will be there in the books of accounts, but you don't know why you received cash from Ram. Okay, so you don't follow cash basis system. We don't follow cash basis system. Cash basis system will be followed by, like, in a very small business like sole proprietor, like, very small businesses will be they will follow cash basis system. According to Companies Act 2013, right, every company who are preparing the books of accounts, they need to follow accrual basis. What is meant by accrual basis? It doesn't matter whether you have received the cash, whether you have paid the cash, we need to record the transaction immediately. For example, in this transaction there is no cash involved, but still we will record in our books of accounts. What do we write? Ram account debit to sales account. You guys remember the journal entries for this? Here I am selling goods to Ram. Ram is a debtor. Debtor is a asset. When asset increases, you will debit it. That's what we have done. And then sold goods. Sold goods means sales. Sales is a income. Income shows credit balance. So like this we are going to record the transaction. So we are going to follow accrual basis, not the cash basis. Now I will tell you, I will write it here. Accrual basis means we record all transactions irrespective of their receipt or payment. That means it doesn't matter whether you received the money or whether you paid the money. Whenever the transaction happen, immediately you will record the transaction. Again, transaction means obviously economic transactions, not like, I love my employees. I cannot write that, right? So I can write all the transactions which are economical transactions. I will record in my books of accounts. Okay, see, if it is expenses, we will record all expenses whenever it is incurred irrespective of the payment. For example, I did not pay salaries this month. Okay, that we call it as outstanding salaries, right? Do we show outstanding salaries in your books of accounts or not? Yes or no?
Only in adjustment entries.
Yes, but anyway you are showing in the books of accounts, right, outstanding salaries. Why? Because of the accrual concept only. Because outstanding salaries means what? You did not pay. It doesn't matter whether you have paid it or not. It matters whether you have incurred it or not. What is meant by incurred? Incurred means obligation created. Okay, let's just say, let's take an example. I have appointed Sam as my employee and he worked for 2 months. And I did not pay salary. Did I incur the expenses? Because salary is expenses for me. Did I incur the expenses? Yes, because Sam worked for 2 months. As soon as I took the services of Sam, I am liable to pay. I am obligated to pay money to him. Let's take another example. Let's say I stayed I took an office for rent, right? I took office for rent for 2 months. Again, when I use the services, when I occupy that office, I have to pay. So obligation is created. When the obligation is created, it's called incurred. Let's take small examples. Let's just say I took internet. I used the internet. Obviously, I incurred the expenses because as soon as I use their services, I have to pay the bill. As soon as I consume the power, I have to pay the bill. Because when you take the services, obligation is created. You have to. That is called incurred. Did you understand?
Yes, sir.
Right? So incurred or due, same thing. Like whenever you incur expenses, the bill will become due. For example, when I incur electricity expenses, electricity bill will become due. Obligation is created. I have to pay the electricity bill, otherwise they won't leave me. Now let's just say if I don't follow this accrual basis, what will happen? Let's take small example. In my P&L account, let's just say I am preparing P&L account only for January. My income is my income is in the income side, it is 50 lakhs. Okay, expenses side, what I have done is I did not pay any expenses. Yes, I have to pay rent, but I did not pay. I have to pay rent, let's just say 20 lakhs, but I did not pay. I have to pay salaries, let's just say 10 lakhs, but I did not pay. And let's just say wages, I have to pay 5 lakhs, but I did not pay. Then since I did not pay anything, so cash is, there is no transaction, like I did not pay anything, cash did not go out from my office. So what I have done is I did not record any of these transactions. Okay, then I said my net profit will be 50 lakhs only, because I did not record this transaction. Is it correct? If I say my income for January is 50 lakhs, is it correct? My net profit, not income, sorry, my net profit.
No, sir.
Net profit means after deducting the expenses, you will get the net profit, right? My net profit is 50 lakhs, I am telling. It's not correct, right?
Yes,
Why
sir.
it is not? Why it is not correct? Because it doesn't matter whether you paid it or not. These are your expenses. These are your expenses. If you did not pay this month, maybe you will pay in the next month. Okay, but these expenses belong to January only. These expenses belong to January only. Okay, so there is something called as matching concept. You need to match the expenses and match the income. It's like you have to write January expenses and then January income, then only both will match. I can say January net profit. But if I do like this, let's just say I did not pay January expenses, but I paid in February. I paid in February, then February income. I paid January expenses when? In February. So whatever the net profit I get, this is not correct. This is not the net profit of February, because expenses and income did not match. Expenses should belong to the same period, income also should belong to the same period. Then only you can say that this is the net profit or net loss for that particular period. Okay, so these are all the basic concepts which we have to be very sure. Okay, again these are all in the first chapter. We're going to go back. So what I am trying to say here is, this rent, salary, wages, if you don't record, your net profit will be too high. Okay, so you just cannot say, so just because I did not pay these expenses, I won't record in my books of accounts. No, you cannot do that. According to accrual concept, it doesn't matter. What do we see? We will see, did you incur the expenses? If the answer is yes, then record it, irrespective of the payment. Whether you paid it or not, it doesn't matter. Can I move on to the next one, guys? Yes.
Yes, sir.
Now next one. Let's same goes for the income also. Income also, record it whenever you earn it. Okay, whenever you earn it, irrespective of receipt. It doesn't matter whether I have received the income or not. It matters whether I have earned it or not. Okay, so here incurred is the important word here. Earned, what does that mean? So that means you have a right, you will get a right to receive. Here you will get a obligation, here you will get a right. What does that mean? Let's just say I have joined a job on 1st January. Alright, so and my salary is 30,000. So that means assume that 30 days in a month, every day I will earn 1,000 rupees. So from 1st January to 30th January, I will get 30,000 rupees. But I left the job on 15th January. Like, let's just say 15th evening, I have completed my work and said I'm quitting. If somebody asks, what is your income of January? Then I will say, I have worked for 15 days in January. Every day I will get 1,000 rupees. So my income is 15,000 rupees. Can I say that? Yes or no? Yes or no? Why? Why? Because I have worked for 15 days.
15 days.
So that means I get a right. If my if my manager or if my owner is not paying the money, so what I can do? I can go to the manager and say, I have worked for 15 days. I have a right. I have a right to receive the money. So that means I have earned it because I already did the work. But did I receive it? No. Manager will say, you wait until the end of the month because the salaries will be paid on the end of the month. But I will write in my books of accounts on 15th itself, or you can say that every day you can write it. Okay, 1st January my income is 1,000 rupees. 2nd January my income is 1,000 rupees. 3rd January my income is 1,000 rupees, because every day as soon as I complete my work I get a right. Because I have completed my work, I earned the money. So whenever you get a right, that is called earning. So whenever you get a right to receive, that is called earning. So you have to record in your books of accounts immediately, irrespective of receipt or not. So you might be receiving the next month or you might be receiving after 2 months. It doesn't matter. I have worked in January. I have earned the money in January. So write in the January itself. Can I move on to the next one?
Yes, sir.
Now this is called accrual concept. So according to accrual concept, we have to record all the transactions whenever it happens, right? If it is expenses, whenever it is incurred. If it is income, whenever it is earned. So we don't care about the payment, we don't care about the receipt. So this is the way we will create the P&L account. This is the way we create balance sheet, trading account, journal entries, everything. All books of accounts will be prepared mandatorily on accrual basis, not on cash basis. Okay, fine. Remember this concept. Next one. We are discussing about the cash flow statement. In this scenario, like while preparing cash flow statement, we don't care about anything apart from the cash. Right? Obviously, cash flow statement prepared based on cash basis, but books of accounts will be prepared on accrual basis. Okay, so while preparing the cash flow statement, we will concern about only cash items, nothing else, and then we concern about the flow. Flow means it may be inflow, it may be outflow, right? So there may be an inflow of cash, there may be a outflow of cash. Whether it is an inflow of cash or outflow of cash, it will happen only if there is a activity. That obviously you need to do something. Like just because you sit on a chair, the money won't come, right? So you just have to do some work, some job, some activity. Let's just say I'm going to a movie, that is also an activity, but I don't earn money because of that. So obviously business have some activity. What does business do? They will do business, right? They have some activities. So if you do any activity, because of that you may get either inflow of cash or you may get outflow of cash. Let's take example, buying of machinery. It is an activity. You are doing something. Activity means what? Doing something. So buying a machinery, it's an activity. Cash is going out, it's an outflow of cash. Okay, paying dividends, again activity, cash is going out. Sale of goods, activity, cash is coming in, that is inflow of cash. So you are doing some kind of activity, because of that your cash is coming in or going out. Fine. There are so many activities in the business. There are so many activities. So we need to classify the activities. So that's why there is something called as AS3, Accounting Standard 3 cash flow statement. So they have already classified all activities into three parts: operating activities, investing activities, and financing activities. Okay, so anything which is happening in the business, you can put into these three activities. Now let's discuss about financing activity first. If there is any change in composition or structure of capital, but remember here the keyword is capital. Anything directly or indirectly related to the capital will come under the financing activity. Okay, now here I used these words: composition or structure. Okay, structure means normally we have equity shares, we have preference shares, we have debenture, we have bank loan. See, these are all what? All are capital only, right? But let's just say if my capital is 100 rupees, like 20 rupees is maybe equity, 20 rupees maybe preference shares, 20 rupees maybe debentures, right? And 40 rupees maybe loan. So my 100 rupees is my capital, but that capital has a structure, right? That this is called capital structure. We have a separate chapter in financial management where we are going to discuss more about it. This will be decided by the financial manager. What should be your structure of the capital? Which one is better? Do I need to take more money from the equity or preference shares or debentures or loan? So basically we're going to discuss about capital structure in that financial management. Now here this 100 rupees, see, I took 20 from 20 from equity, 20 for preferences. That means 20% is equity, 20% is preference shares, 40% is loan. This is called composition, right? Are you guys following this or not? So change in the composition or structure of the capital. Let's just say I repaid the loan. What will happen if I repay the loan? My structure will change. Okay, or let's just say I have redeemed the preference shares. 20 will become, let's just say, 18. Again, my composition will change. So in other words, we can say that if it is something directly or indirectly related to the capital, okay, directly or indirectly related to the capital, will fall under the financing activities. Okay. Next, investing activities. So we can say that acquisition and disposal of assets and non-current investments, but we will write in a simple words. In other words, we can say buying and selling of assets and non-current investments. Okay, so here the keyword is assets. Buying and selling of assets and non-current investments. So if anything related to the assets, again remember here, not current investments, non-current investments. I will explain this about later, because the current investments will come under cash and cash equivalents. That is different part, we will discuss later. Okay, so investing activities means anything related to the buying and selling of assets And then operating activities. See, if it is not a investing activity, if it is not a financing activity, definitely it is a operating activity. Or we can say that any transactions or any item related to the principal business, that means main business, principal business, then it will be called as operating activity, right? If it is related to the principal business, then it will be called as operating activity. Okay, now I'm gonna write few items or transactions here. You guys classify me which one is which. Okay, both of you. We have how many people? 2 people only, right? Yeah, Tisha and okay, 3. Tisha, Pooja, Keshav, all 3. You keep on classifying this. Now, sale of goods. Which activity?
Operating.
Operating. Why?
Because it's related to the day-to-day operations of a business and related to economic activities of business.
It's not a principal business activity, not economic, because everything is economic only. Yeah, it's related to the main business, principal business. Yes. Now, salaries to employees. This
will also operating activity.
okay. Then purchase of machinery,
Investing activity.
because it is related to the assets. Okay. Profit on sale of machinery. This is
Investing activity.
okay. Interest received on investments. This so when I meant investments, so it is non-current investments.
Oh, then it
Okay.
is investing activity.
Investing activity, even if it is like obviously there is no other, it won't go to the operating, it won't go to the financing, because I received the interest. That means what, I might have invested my money somewhere else, so because of that only I am receiving the interest, so that is investing activity only. Then interest paid, same thing. Which activity?
Financial.
Hold on. Yeah, it won't be, because if it is investment we won't pay the interest. So interest received, normally obviously we will receive because of the investment. Interest paid because of maybe for debentures and maybe for loan. Yeah, these things are what?
These all are comes in financing activities.
Financing activity. Yeah, Keshav, correct. So financing activity. So these two things, because debentures related to the capital, loan related to the capital. Okay, so if it is interest received, that means it might have been investing activity because we are receiving the interest, and then if it is interest paid, it is a financing activity. Now, dividend received. This will be which activity?
Financing activity.
Investing activity. Dividend received. So when do we receive the dividend? When we invest money in some other company shares or some other company's preference shares, right? So if you are investing money somewhere else, then only you are going to receive the dividend. So investing is a investment activity. So it's a investing activity. Next one, dividend paid. This will be
This will be financing activity.
Yes, it is financing activity because we are paying the dividend. That means we might have issued the shares to them. So issuing shares is a financing activity. Remember that whenever you are issuing equity share, preference share and debentures, these are all financing activities because these are all nothing but raising the capital. Okay. Now what about this redemption of preference shares or debentures? This is which activity?
Financing.
Financing activities. Okay. Now let's little bit complicate it. Now which activity?
Financing.
Now the same transaction, loan taken from bank, and my company is a banking company or financing company. Like like finance companies, Bajaj Finance, all this are there, right? So my company is that, and I have taken a loan. Which activity?
Operating.
Very good. Operating activities. Because it depends upon the nature of my business, right? You need to think that this is nature of my business. So if you go for the bank, if you think from the financing company, their main business is giving finance and taking finance, giving loans, taking loans, right? So that's why for them that is their main business. Main business means operating activity. So if it is a non-finance company, we will take loans because of the capital. Capital means financing activity. Okay. So but here you need to see the nature of business also. So since giving loans and taking loans is a main business for the banking company or financing company, it is a operating activity. Next one. And now which activity? Investing. Okay. Now same thing, my company is a investing company. Right, my company main business itself making investments, like some kind of stockbroker or something. So my main business itself buying and selling of investments. My company itself is an investment company. Then which activity? Operating. Yes, very good. Operating. Fine. Now which activity?
Operating.
TDS means tax deduction at source. Why it is operating activity?
Because it is we have to pay part of taxes. That's why, like, interest received, then it will
Investing
be.
as a
Yes, very
Yes.
good. See, normally
Yes.
interest received is a investing activity. Investing cash inflow, right? Interest received is what? Investing cash inflow. But you are paying TDS. Why you are paying TDS? Because you are receiving the interest, right? So why you are receiving the interest? Because of the investment. So that is the thing. This transaction is investing cash outflow. If I mentioned only interest received, then it is a investing cash inflow. What did I mention here? The transaction is about the TDS. I paid tax deduction at source on interest received. So this transaction is a investing cash outflow. Okay. Now, which activity?
This is operating activity.
Very good. Income tax refund? Same. If it is paid is operating activity, refund also operating activity only, right? Okay. Now, so these are all examples of operating activities, investing activities and financing activity. Remember, whenever you are doing these activities, you need to remember the keywords. If you are doing financing activity, remember the composition, structure, capital. The keyword is capital. Anything related to the capital is financing. Investing activities, anything related to the assets. Okay. Operating activities, anything related to the main business. See, most of the times, normally investing activities and financing activities are very limited. Okay. The scope is very limited. But operating activity scope is so much. So that's why sometimes if there is a conflict, we don't know under which activity it will come, so then it will come under the operating activities only. If it is not falling under investing and financing, automatically it will fall under the operating activities. Next, we need to prepare cash flow statement. So for that we have two methods. One is direct method, another one is indirect method. Direct method, all you need to do is you just write all operating activities in one place, investing activities in one place and financing activities in one place, and then answer is done. We are not going to discuss much about it. Yes, we will do one or two problems as a homework because that is so easy, and 95% they won't ask that. Okay, maybe if they ask they will ask you to classify like this. They will give some transaction, they will ask you to classify. That's all. Now we are going to concentrate on this indirect method. Okay, so before discuss indirect method, there are few basics or topics which we need to know. Okay, they will give in the question a schedule 3 format balance sheet. I hope you already know how the balance sheet look like, right? So they're going to give a schedule 3 balance sheet. Now first thing we need to look in the question. See, the question will be big, the adjustments will be big, but we don't need to worry about that because the question is so big. How can I solve this? No, we need to know the format. Every question you follow the same format, you will get the answer. So this is the format. We will come to this format little bit later. Now if you see the question, yeah, so this is schedule 3 format. I'm just looking for a better format. Yeah, so this is schedule 3 format. They are going to write all equities and liabilities in one place, all assets in one place. Again, they can give better, but for some reason they did not write this. They did not much classified some in schedule 3 here. So we need to look for this P&L account. Okay, we need to look for this. Okay, now in the exam there is something called as surplus. They might have used the word surplus. Now we should understand what is meant by surplus. Okay, so when you do P&L account, what do you get? When you prepare P&L account, what do you get? Net profit and net loss, right? Now, is that net profit before deducting the tax or after deducting the tax? Anybody? In the P&L account, you get net profit before tax or after tax?
Before tax.
Before tax. Actually, it is after tax. We are going to deduct the tax also. Okay, but before discussing that, I guess you should know these words. There is something called as provision for tax and income tax paid. So what is meant by provision for tax? First of all, why do we need to create a provision for tax? So provision means basically it's like, we're just keeping money aside. Why should we do that? Any idea about provision for tax, Pooja? Any idea?
Sir, just you said to pay the tax.
That's it?
Yes, sir.
Okay. How about you, Tisha and Keshav? Tisha?
Companies made some amount of tax that
But you know it. You don't know how to explain, but you know it. Right?
yes.
Okay. Now, I'm going to explain it. Now you tell me after that. So, is it the same or not? Okay.
Okay.
So, you guys know what is previous year and what is assessment year?
Yes, sir.
Okay. So, previous year is the year in which you earn the income, and then assessment year is the year in which you pay the tax. Right. So, if I earn the money in 2022, I will pay the tax in 2023. Okay, let's just say 2022-23 and then 23-24. Now just now we discussed what matching concept, right? So what does matching concept will tell, Tisha?
Whenever is income happened, we record that.
In simple words, you need to match the expenses and income.
Yes.
Right? Expenses should be related to the same period. Income also should relate to the same period. Okay. Then if I follow, like, according to the income tax, if I earn money, that means I am getting a profit in 2022 and 23, but I am paying tax in 23 and 24, right? So in 23 and 24, let's just say I'll prepare P&L account of 23 and 24. In my expenses side, I will write tax paid for 22 and 23. Now see, this P&L account is 23 and 24, but this is a expenses belong to 22 and 23. Is it matching? So all income here will be there 23 and 24, right? Because you are preparing a P&L account, so income will be there for 23 and 24. But expenses, you are writing one expense which belong to 22 and 23. Is expenses and income matching?
No, sir.
No. So that means you are violating the this matching concept. You should not do that. So that is the reason we will come up with provision. Okay, the one more thing. So these are not matching, fine. But at the same time, I cannot pay tax in 2022 and 23 because according to the income tax, you have to pay to the next year. But our account says, it doesn't matter, I don't know all those things. I want you to, in your P&L account, 22 income should be there 22 expenses should be there. So you should deduct all expenses this year only. You cannot say, you pay the tax next year, so I will deduct next year, means we won't accept it. So that is the reason we will create a provision. Okay, we are going to keep, let's just say, based on the estimate. Obviously we know the tax rates, right? Obviously we know how much is our profit, so we can actually estimate how much tax we are going to pay in the next year. So let's just say I'm going to pay tax of 50,000 in the next year. So this money I am going to deduct now only. But am I paying tax to the government? No. But I'm deducting it. And deducting and putting in a separate account. Okay, deducting and putting in a separate account. I should not use this for any other purpose. Okay, I should not use this any other purpose, because this is a provision which is created for tax payment only. So since you cannot use it for any other purpose, this is a liability. Okay, because you're just taking money from P&L account, that means you are deducting from the profits. Obviously, well, when you debit in the expenses side, your profits will decrease. Okay, so you are taking 50,000 from where I am taking? From P&L account. So journal entry you will write like this: P&L account debit to provision for tax account. Okay, then in P&L account it will be to provision for tax. So because of this, what will happen? My net profit will decrease, right? If you debit the provision for tax, my net profit will decrease. Okay, now you are taking this money from P&L account, from the current year profits, and then you are putting in a different account, and you should treat this as a liability. So that's exactly why you will write in the you will write this in the liability under the balance sheet. In 2022 and 23, you are going to put this under the liability side, because you have to pay this money to the income tax department only. You are liable to pay this money for the income tax department only. You cannot use this for any other purpose. Now you understand what is the need of creating the provision for tax, right?
Yes,
Any
sir.
doubt? Three of you, any doubt?
No, sir, no doubt.
Okay, so the thing is, we cannot pay tax this year, we have to pay tax next year only, but I need to match the expenses and income, so I need to debit the tax this year only. So that's why I will create provision for tax. So whatever I am getting here, net profit, this is after tax. Net profit after tax. Now come to the another scenario. Okay, so in 2022 and 23, I will create the provision for tax for what? For how much? 50,000 rupees, right? Now what is the journal entry? What did I write? What is the journal entry I have written? From where I have taken this money?
Provision for account.
Provision for tax is what? It's a liability.
Yes.
Liability shows credit balance. Remember, not only this, any kind of provision will be taken from P&L account only. So P&L account debit to provision for tax account. Provision for tax account. See, since it's a liability, that's why we have credited it. 50,000, 50,000. Again, this is a dummy account only. Since we are going to pay tax next year, until that we are going to put money in this account. Okay, let's take let's just say you are going to a vacation, right? You are going to a vacation of let's just say Goa, right? Then you'll just create one dummy account, Goa trip account. As soon as you go to Goa, you will use this, and then you will cancel the Goa trip account. In the same way here also, you want to pay tax next year, right? So until next year we are keeping money here. As soon as next year comes, we have to pay tax, so we are going to use money from our provision for taxes, and then this will get cancelled. Okay, this I have written in 2022 and 23. Remember that provision is created on normally every provision, like depreciation, pretty much everything Everything will be created on estimation basis. Okay, this estimation will be done by the management, board of directors, all these people. Okay, now I have taken 50,000 rupees and then I created the provision for tax. Now next year, what is the next year? 23 and 24. In 23 and 24, what should I do? I need to pay the tax, right? Because this is assessment year. In assessment year, I need to pay the tax. So can I take money again from current year P&L account, or can I use the provision for taxation which is created in the last year?
Provision for taxation account.
Okay, now I am using that account. So previously provision for taxation account is credited. Now I am going to debit it. Provision for tax account debit to bank account. To bank account. That's all. The same process is keep on repeating. Okay, so now 50,000, 50,000. Because of this, what will happen? This one will get cancelled. Then P&L account debit. So when does this P&L account debit happen? In 2022 and 23. And then obviously you are paying in 23 and 24. It doesn't matter when I am paying, because I am preparing the books of accounts on accrual basis. When it happened, when did I deduct the expenses or not? Yes, I deducted. When I deducted? In 22 and 23 itself. So I am paying from 22 and 23 profits. I am paying in 23 and 24. Any doubt? Like I said, this is a dummy account. Dummy accounts always get cancelled.
No doubt, sir.
No doubt. Very good. Okay. Now there are some things might happen like this. Like I said, this is done on estimation basis. Now 50,000 rupees. 50,000 rupees. That means 50,000 I estimated and I exactly paid 50,000. But what happens? Let's just say I created provision for tax for 50,000, but I have actually paid only 45,000. Okay, or I have actually paid 55,000. Can happen. Estimation can go wrong. Then what we're gonna do? Okay, so when I created this provision, I am taking money from where? From P&L account debit 50,000 to provision for tax account. Provision for tax account 50,000. First we will discuss this part. Actually paid only 45,000. So then what's going to happen is we are going to pay provision for tax account debit 45,000 to bank account 45,000. Okay, total how much money you have credited? So 50,000 credit balance was there. Now here we debited 45,000 you have debited. Still you have 5,000 credit balance is there. Then what we're going to do is this will be carry forward to the next year. Okay, so this is in 2022 and 23. This is 23 and 24. This will be carry forward to the next year. So this will be closing balance of the current year. This will become the opening balance of the next year. Understood or not?
Yes, sir.
Okay. What happens if there is more tax, if I am paying more tax? If you are paying more tax, then take from the P&L account. Okay. So provision for tax I have used fully. Provision for tax account debit 50,000. Then remaining money I am going to take from again P&L account debit 5,000 current year P&L account to bank account 55,000. Like this. This is not much given. That is just for knowledge only. So because of this, opening balance and closing balance will be created. Now, are you guys absolutely sure on this? Can I go to the next concept in the provision for taxation only?
Yes, sir.
So what they are going to do is they are going to give a balance sheet. In every question, they are going to give balance sheet. In the balance sheet liability side, they are going to give like this. In 2020 and 2021, they are going to give provision for tax, and This is like 45,000. Let's just say this is 65,000. Now provision for tax is an asset or liability?
Liability.
Liability shows
Credit balance.
yes. So they give this in the balance sheet. In the adjustments, they are going to give okay. Now can I say like this? Every year you will do two things. One is every year you need to create the provision, and then every year you will pay the tax. What does that mean? Say in 2022 and 23, let's take this is the first year. So this is the previous year. What I'm going to do? I'm going to create provision for tax, right? But I am creating the provision for tax. From where? From my P&L account. Fine. This is creation of provision for taxation. This is creation. Then let's come to 23 and 24. Let's come to 23 and 24. This is the assessment year. In assessment year, what I am doing? I am paying the tax. Income tax paid. From where? From the last year provision I am paying the income tax, right? Then I am also creating provision for tax. For what? For 24 and 25. Because this year will become the previous year for the next assessment year. 24 and 25. This will become the previous year. This will become the assessment year. Okay. So again next year I have to pay the tax, income tax paid. From where? From last year provision, and then again I need to create the provision. So do you guys agree? Every year two things is happening. One is I am creating the provision for the next year, and another one is I am paying the income tax from the provision which is created last year. Agree? Understood?
Yes, sir.
Next one. So when I create this ledger, so two things will happen obviously. Every year two things, creation and paying the income tax. So the ledger will look like this. Provision for tax. In the question itself, they will give the opening balance and closing balance. Like you said, provision for tax is a liability. Liability shows credit balance. So opening balance will come in the credit side. Remember that. So by balance brought down. What is the opening balance? 2020, 45,000. Okay. And then what is the closing balance? 65,000. To balance carried down 65,000. Now I already told you why this opening balance and closing balance will be there, right? Because the estimation will not be correct. Like let's just see, if I estimated 50,000, income tax paid won't be 50,000. I might have paid less, right? If you have paid less, whatever the money remaining in your provision will be carried forward to the next year. So that's why opening balances and closing balances will be there. Fine. Every year we'll do two things. What is that? We have to create the provision. We have to pay the income tax. Now, whenever you create the provision, what is the journal entry? Can you tell me, Pooja? Whenever you create a provision for tax, what is the journal entry?
So, P&L account debit to provision for tax.
So, P&L account debit to provision for tax. We are in provision for tax ledger. So, can I say by P&L account? Okay, by P&L account. This they did not give. In the question, how much provision we created, they did not give. But what did they give? Income tax paid 2,000 they have given. Now, income tax paid. Whenever you pay the income tax, you will pay from where? P&L account or provision?
Provision.
What is the journal entry?
So, provision to bank.
Yes, so in provision for taxation it will be 2 bank account, right? So they said 2000, so let's write that 2000 and then try to tally this. So 65 and then this will be 67 and then 67 minus 45, 22,000. So this 22,000 is balancing figure. So in every question they won't give these highlighted items. Like, total 4 items should come in provision for taxation. Obviously they will give the opening balance, they will give the closing balance. So they will give either creation of P&L account, creation of provision for taxation, or they will give either how much tax paid. In this question they just given how much tax paid, that means this item, and then we found out how much provision we created during the year as a balancing figure. You understand? So out of 4 items they will give 3 items, remaining item you need to find as a balancing figure. So first of all, why do we require these highlighted items? That this is required, there is a format of cash flow statement, right? So if you want to do that format properly, you need to get this items correctly, or else it will be wrong. No doubt at all?
Yes, sir.
Okay. Now sometimes what they will do is they won't give anything in the question. That means in the adjustment, that's it, the adjustment they did not give anything. Then what should I do? In the adjustment they did not give any item. But if I want to finish my ledger, I require at least 3 items. If I get 3 items, another item, I can find it as a balancing figure. But they did not mention anything. They just given the opening balance and closing balance. So whenever they do like that, same thing again, I will create a provision for tax. First opening balance, which is 45,000, by balance brought down 45, and then this is to balance carried down 65. Okay, you will take closing balance as the provision created during the year. That means we will assume 65,000 is the provision created during the year, which is this one. Okay, now if you do this, automatically income tax paid will be to bank account 45,000. Balancing figure will be that only. If you want, you can check. So 45 plus 65, it will become 1110. This side also you want it to 1110. 1110 minus 65, you will get 45,000 as a balancing figure, which is nothing but opening balance. Okay, so if they did not mention anything, they did not mention how much provision you created this year or how much tax you have paid this year, then you take opening balance as the provision creation during the year. Done. Everybody done? Understood?
Yes, sir.
Now, so whenever they mention in the question P&L account profit, whenever they mention P&L account, they just mention P&L account. What does that mean? P&L account or profit from P&L account, that means it is a net profit after tax. That is net profit after tax. Or sometimes they will mention surplus. What is meant by surplus? That also we need to know. Okay, surplus means surplus is equal to net profit after tax. Obviously we'll get this figure from P&L account, right? Then this net profit after tax will get from P&L account. Okay, or let's do this one. So basically we have net profit before tax. From that you will deduct tax. Tax means provision for tax. Net profit after tax. Okay. Then from that you are going to deduct dividends. When I meant dividends on both equity and preference shares. Okay, then you will get surplus. After deducting everything, okay, you will get surplus. Understood?
Yes,
But
sir.
in the question, if you see our format, what do we want? If you see the format, our answer is starting with something called as okay, yeah. So if you see our answer is starting with something called as net profit before tax. But in the question they have given this. They used the word surplus, right? So that means they have given this item. So what should we do? We want to go from here to here. From surplus to net profit before tax. What I'm gonna do? I'm going to start with the surplus. Whatever I deducted previously, I deducted dividends, so I'm going to add back that dividends. Then I have deducted tax, then I'm going to add back tax. Then I will get net profit before tax. From here I will start my answer. I will tell you why later, right? But this is the starting point of answer. So in the question what they have given, see in the question if they are given directly net profit after net profit before tax, you can start your answer directly with that only. But instead of using the net profit before tax, they used the word surplus. If they used the word surplus, then you need to add back the dividends, then you need to add back the provision for tax, then only you will get the net profit before tax. Okay, this tax means this is provision for tax. Okay, understood?
Yes,
Got
sir.
clarity? Now if they have given just like this, what do we want? We want a net profit before tax. In the question they have given net profit after tax. In the question net profit after tax, or nothing but they have given profit from P&L account, or they simply given P&L account. What does that mean? In all these scenarios, P&L account means what? Profit from P&L account is nothing but net profit, right? So is it before tax or after tax? Just now we discussed
After tax.
after tax, because in P&L account you will deduct tax every year, so that is after tax. Now in P&L account, do you deduct income tax paid or provision for tax? In P&L account, okay, do you write provision for tax or income tax paid?
Income tax paid.
No, income tax paid will be from provision, right? Because this year income tax we won't pay, right? Every year we will create the provision, right? This provision will be used in the next year, right? Income tax will be paid from the provision for tax, right? Not the income tax paid. Okay, we won't pay the tax. We will always create the provision for tax. Okay, we will deduct what? Provision for tax. So you will get net profit after tax. Okay, but what do we want? Net profit before tax or net profit after tax? We want to start our answer with net profit
Before tax.
before tax, but we got net profit after tax in the question. Okay, so what I'm gonna do is, I know they would have deducted the provision for tax because this is expenses, right? So in the P&L account they would have deducted provision for tax, and after that I got an answer net profit after tax. This is given in the question. This is given in the question. Now they deducted the provision for tax, so I am going to add back. So provision for tax. So provision for tax, whatever we created in the current year, that provision. Obviously we will get net profit before tax. Okay, so whenever you are starting the question, you need to check what they have given in the question. Did they give profit from P&L account or net profit after tax? Then if they give net profit after tax, simply you add back the tax, because they have deducted the tax, you add back the tax. See, whatever they have done previously, you need to do opposite. So they have deducted the tax, so now I have added, I will get the net profit before tax. If they given the surplus, they would have deducted tax, they would have deducted dividends, all these things. So that's why I will add back everything. I will get the net profit before tax. So you need to check what they have given in the question. This is the first thing you need to look for a question in that question before you start your cash flow statement. And also you need to do always this net profit before tax as a working note. First complete the net profit before tax working note, then only you start your format. Okay, so can I move on to the next topic?
Yes, sir.
Now, see, what I am doing is, I'll tell you the format, then I want to discuss something about the dividends. What is the format? Net profit before tax and extraordinary items. And remember, I told you there are two methods to complete the cash flow statement. One is direct method, another one is indirect method. That is only for the operating activities. For investing activities, financing activities, there is no methods. Like there is no 2 methods or 3 methods. There is only it's same. Only for operating activities there are indirect method and direct method. So we are doing now operating activities, cash flow from operating activities. Okay, now I'm gonna put dummy account here about the P&L account. You guys tell me whether it is correct or not. P&L account, from trading account I got the profit. By gross profit brought down 50,000. To salaries paid 20,000. To depreciation 10,000. To loss on sale of asset 2,000. And by profit on sale of investments 10,000. And let's say by interest received on investments is 10,000. By dividends received 10,000. And to provision for tax 5,000. And to rent 5,000. Okay, let's see now. Total I got 60, 70, 80,000 this side. So both sides I will write it. Then I will write 32 net profit. Obviously this is after tax. Whatever I am getting is after tax, remember. Profit after tax. Okay, so 30, 32, 37, 37 plus 5, 42.
No.
So 80 minus 42, 38,000, right? Correct? Now, any doubt in this?
No, sir.
Nothing. This is a normal P&L account, right? Okay. Now, whenever you are preparing cash flow statement, see, what do we want to do is, we want to show how did we get the cash and where did we spend the money. Okay, from where we got the cash, from where we spend the money. Otherwise, what is the point? If you are just doing plus and minus, people can't know. The main reason we are preparing the cash flow statement so that people can read it, not only cash flow statement, all financial statements we are preparing so that people can read it and then take a rational decisions. Okay, how that? Let's just say there is a company, B company. The profit is 30,000 and then 20,000. So which company is better? Everybody will say A company is better because the profit is more. But A company got the 30,000 because they have some land and buildings, so they got 25,000 rent, and then sales they got 5,000 only. And then B company, entire 20,000 they got it by sales only. Now if you ask which company is doing better, what you will say? A or B?
B.
B, because the money which is coming, just a
Because of
second.
sale.
Yes, yeah, go on. Because of sales. Just a sec. So it is coming from the sales because that company is doing better. A is getting more money just because they have some land and building, right? So that is the thing. You understood this when I have given you more picture. Like if I just mentioned the profit, then obviously you would have put your money, you would have invested your money in A company only. Since you are reading from where the cash is coming or where the company paying the cash. Let's just say the company is paying cash to more loans, more interest. So that means the company has some capital issues, capital problems, right? So whenever cash flow statement is presented, you have a better idea about the company. So where I am getting money and where I am spending money. So that is the reason you are preparing. So that is exactly the why we need to classify. We need to classify, is it an operating item, is it an investing item, is it a financing item. So this classification is important. Now if it is a direct method, we'll just write all our operating in one place, all investing activities in one place, all financing activities in one place. But now we are doing indirect method. Okay, we are directly starting from this point. We are starting this 38,000 because this is indirect, right? So that's why we are starting with this 38,000. Now how did we get this 38,000? Now you see in the P&L account. Now you tell me, salaries paid, which activity? Operating activity. What about the depreciation?
Investing.
Operating.
Okay, first of all, does it will come in cash flow statement?
No.
Because it is a non-cash item,
Non-cash item, yes.
right? So it won't come in the cash flow statement only. Okay, now what about this one? To loss on sale of assets.
Investment.
Provision for tax.
Operating.
Rent.
Operating.
by profit on sale of investments?
Investing.
Interest received, uh, investing. Dividend received, investing.
Invest.
Now if you see this profit, this 38,000 whatever we got, this is, we have added some operating activities and or deducted operating activities. There are so many other items, right? Like investing activities also is there, financing activities also is there, operating activities also is there. Because while writing the P&L account, we don't care which activity is that. We will only concern, is it an expense, is it an income? That's all we concern about it. We don't care whether it is a operating activity or whether it is a financing activity or investing activity. But now we are doing what? We are doing cash flow from operating activities. We want only operating activities. So if there is any other activities like profit on sale of investments, interest received, so can I call these things as non-operating activities? Can I do that? If it is a investing activity or if it is a financing activity, obviously it is a not an operating activity, right?
Yes,
So I can call them as non-operating activities. But what do I want? I don't want any other activities apart from operating activities. Now if you see, I have profit on sale of investment. Did I add this to my profit or did I deduct from my profit? My profit is 38,000. My net profit is 38,000. This item, this profit on sale of investment, did I add it or did I deduct it? You are writing that on the credit side. So that means, is it like an addition or is it like a subtraction to the profit?
addition.
It's an addition. Okay. And then here, the loss on sale of asset. Now is it an addition or subtraction?
Subtraction.
Subtraction, right? Subtraction from your profit. So in other words, this non-operating activities are affecting your profit, right? Right, because of loss on sale of asset, your profit will decrease. Because of the profit on sale of investment, your profit is increasing. But I don't want this non-operating activities. I want only operating activities. I want the profit only from operating activities. Okay. And also this non-cash item. This is a non-cash item. So because of this, my profit is increasing or decreasing because of this depreciation? Because of depreciation, my profit is increasing or decreasing?
Decreasing.
Decreasing. But is it really cash going out anywhere?
No, sir.
No, the cash is not going out. So that's why we need to add it back. So because I don't want this non-cash item, I don't want this non-operating item affecting my profit. I want this 38,000 whatever we got. This is not the operating profit. In simple words, I want only operating profit. So if there is any other items affecting my profit, I should eliminate them. So to eliminate, what I'm going to do is I'm simply going to do opposite. For example, profit on sale of investment I have added. So there I'm going to deduct it. Depreciation, which is a non-cash item, I have deducted. Then there I'm going to add it. So if I do that, both will get plus and minus will get cancel. That item is going to eliminate from my profit. Understood? Now
Yes.
here also provision for tax I have deducted. I know that this provision for tax, whatever I'm keeping some money aside, I know that I am not going to pay this year. I am going to use this provision in the next year. That means there is no cash going out, right? Then why did you deduct? If there is no cash going out, why did you deduct? We are everything on cash basis because we are preparing cash flow statement. We only concern about the cash. cash is not going out, but you deducted. Because of that, your profit decreased. So that's why I'm going to add it back. So now, coming back to the format. First, we want net profit before tax. This you should always do working note number 1. Okay, so if they have given in the question net profit after tax, then add back the provision for tax for current year, then you will get the net profit before tax. Okay, then extraordinary items. In the same example, okay, assume that there is a loss on fire. Because of the loss on fire, my net profit will increase or decrease. If there is a loss on fire, I will write it in the debit side, expenses side. Because of that, my net profit will increase or decrease? Decrease. And it is not going to happen regularly. See, this extraordinary item means the name itself is there. This will happen, beyond your business activities, like fire, earthquakes, cyclones. So it is not. So let's just say in 2020, COVID is there. Because of that, my profit is decreased. In 2021, there is no COVID. So let's just say my profit is 30,000, here 10,000. Now is it both are comparable? Can I compare these two? Can I compare these two and say this company in 2022 it is it's really doing bad, now it is doing good? I cannot say that.
No, sir. No.
Because in 2020 it is doing bad because of some extraordinary item. Like not because business is bad, it's because of some extraordinary item. So while taking the decision, we don't want any extraordinary items. So that's why we are going to eliminate them. So if you have added, now you deduct it. If you have deducted, now you add it. That more about we will discuss while doing the question. Next one. So this is the format. First thing what we're gonna do, we're gonna add back all non-cash / non-operating expenses, because in P&L account expenses you will deduct it. So now I'm going to add here. What are the examples? Depreciation, loss on sale of assets, and interest paid. These are all what? This is non-cash, and remaining all are non-operating. Okay, interest paid. Then what else? Dividend, if there is any dividend paid. Okay, now same thing. If it is a income, non-cash / non-operating income, because you would have added income to your profit. Now I am deducting it. Just tell one example, which is profit on sale of investments, dividend received, etc. Okay, if you do this, you're going to get something called as cash flow before working capital changes. Cash flow before working capital changes. Working capital means current assets minus current liabilities. Okay, so that means here we will concern about only current assets and current liabilities. Okay, so you'll get cash flow before working capital changes. Then let's do one box here. I'm going to explain this more about while doing the questions. There is a current asset, there is a current liability. It may be inventory, it may be debtors, right, or trade creditors, or loans, overdraft, whatever it is. So we need to know whether it is a current asset or current liability. Now check, is it increasing or decreasing? Now when current assets, let's come with the decrease part. When current assets decreases, let's just say my debtor is 50,000. Okay, but now it is only 30,000. What does that mean? That means I recovered money from my debtor, right? I recovered money from my debtor. That means it is a inflow. Okay, now take an example of debtor here, and then here take an example of creditor. Now let's go for the creditor. My creditor was 50,000. Now again it is 30,000. What does that mean? Previously I need to pay 50, but now I need to pay only 30. That means remaining 20 I paid. This is a outflow. Okay. Then if it is increasing, you just write opposite. So this is outflow. This is inflow. So make sure you do this box every time, and I will explain why this is inflow, why outflow, why we have to take this later. Okay, but this is kind of like, you call this as trick or whatever it is. So you start with this current assets, consider it as a debtor. When debtor decreases, obviously we will get the money, right? That means our customers are paying, so it's an inflow. When creditors decrease, that means we are paying to our suppliers, so it is an outflow. Remaining you write just opposite. So make sure you do this box every time. Okay, so if it is an inflow, you will add it. If it is outflow, you will deduct it. To what? Here you got cash flow before working capital changes, right? So for that you are going to add this inflows and outflows, deduct outflows, add the inflows. Then you will get cash flow from operating activities. Cash flow from operating activities. Then you are going to deduct finally income tax paid. Now you remember we created a provision for tax ledger. There to bank you got income tax paid. That information is required here. And then here, while doing the working note, provision for tax for the current year, creation of provision for tax, that information is required here. So that ledger, total 4 items will be there. The 2 items will come either here and here. So after that you will get the net cash from operating activities. Net cash flows, you can write net cash flows from operating activities. That's all. This is the format for operating activities. Financing activities and investing activities, it is not a big deal. Okay, understood?
Yes, sir.
Okay. Shall we continue, or no, we'll continue in the next class? Guys, are you understanding?
Yes, sir.
Because if it is too silent, I don't know like whether you are understanding or listening or not. So try to participate as much as possible. And maybe we will discuss one last concept, then we'll close this session, then we'll start later. Now whenever there is a dividend is there, okay, so there are 2 types of dividend. Remember, there are 2 types of dividend. One is interim dividend and another one is proposed dividend. Or final dividend. Okay, for dividend chapter we have so much to discuss in the law part, so I am going to do only accounting related part. See, interim dividend means it is a dividend paid between 2 AGMs. Okay, between 2 AGMs, or in other words, it is paid during the year, right? If you are paying the dividend during the year, then it will call interim dividend. Proposed dividend means, first of all, board of directors will propose it, then AGM they will conduct it. Okay, they will conduct AGM. After approval of the shareholders, then we will pay it. Okay, after approval of the shareholders, then we will pay it. Let's just say board of directors, what they will do is they will read the financial statements. Okay, so if they think, okay, so this year we are doing well, so we should get dividend, so we should distribute dividends. Who will decide that? Board of directors. Let's just say they decided in 2023 and 24. Okay, so that is proposed dividend. They just proposed it. See, the money did not go anywhere, and it is not a liability also. They just suggested, proposed. So then in the next year, like 2024 25, at some date, they are going to conduct AGM. So in AGM, all the shareholders will come and then they give a approval. Yes, dividend is approved. Then the company gets a liability. The company definitely has to pay. Okay, so once the approval is happened, the company has to pay. Okay, within what time, all those things, again law part. So that means what's happening? The proposal is happening in 1 year, paying the dividend is happening in another year, right? So there is no cash is going out. Let's just say the proposal is happening in 2023 and 24. There is no cash is going out. When the cash is going out? In 24 and 25. Okay, in 24 and 25. So in the question they will give two things. One is proposed dividend of previous year, one is proposed dividend of current year. Okay, we don't want current year. We don't care about the current year, because the current year dividend will be paid in the next year. The proposed current year, that means it will be paid in the next year. We don't care about it. But proposed dividend of previous year will be paid this year. That means cash is actually going out. Now this we concern about it. Okay, now let me write this again one more time, because previously what did we write? Surplus part. What did we write there? We have written net profit before tax and extraordinary item. That what we want, right? Extraordinary item. I want you everybody to write this. Just give me a second. Okay, just a second. Okay, so net profit before tax and extraordinary item, we want it. This is the first working note. Okay, so let's just say they are given surplus in the question. The surplus is 50,000, and then they are given in the question like this. In the adjustments they mention proposed dividend of current year is 20,000. Proposed dividend of previous year is 20,000, and provision for tax they will give opening balance and closing balance. Yes, provision for tax for current year. This you will get by creating the ledger. Okay, remember we create a ledger of provision for tax. Okay, then they will also give interim dividend. Okay, interim dividend, let's just say 5,000. They will also give loss on fire, let's just say 5,000, and then they will also I'm writing everything here. Insurance received because of the fire, insurance received, which is, let's just say 10,000, or let's take 2,000. Okay, insurance received 2,000. Next, income tax refund. Income tax refund is 5,000. Okay, now one by one, they won't give all this information in one place. They are going to give separately. For example, provision for tax they are going to give in balance sheet, and then remaining all information normally they are going to give in adjustments. Now Tisha, what do we want? What is our objective? We want to find out what? Net profit before tax and extraordinary items. So there should not be any extraordinary items and tax should not be there. So we are starting with this. First you write surplus 50,000. Okay, then if you remember, how do we get from surplus to provision for tax, net profit before tax? Here,
By adding
right?
depreciation, dividend and provision for tax.
Very good. So here, right? So they have given surplus in the question. Now we want to go back to the net profit before tax. So for that you should know, how do we get surplus? We get surplus after deducting the tax, after deducting the dividends. That means they have already deducted the dividends, they have already deducted the tax, so that's why they got surplus. Now we need to go back to the net profit before tax. Okay, that means we need to do opposite whatever they have done. Okay, now surplus. First I am going to add back the dividends. Now tell me, propose the dividend of current year, propose the dividend of previous year. Which one I should consider?
Previous year.
Previous year, because whenever you pay the dividend, then only you would have deducted the money, right? You did not pay this only, because this current year dividend will be paid in the next year. So we don't care about this. So proposed dividend of previous year I would have paid, that means this would have deducted. Now I am going to add back. Then provision for tax for the current year, I would have deducted or I would have added it? What should I would have done?
Deducted.
So now add it. Provision for tax for current year I would have deducted, which is let's just say 10,000 rupees. Then interim dividend. See, any dividend, whether it is a final dividend or proposed dividend, when you paid it, okay, you would have deducted it. Now you need to add back. So interim dividend, there is no adjustment, nothing to worry about it. 5,000. Okay, now if you do all these things, you're gonna get, okay, net profit after tax. Fine, but we want net profit before tax and extraordinary items. Now loss on fire, is this ordinary item?
No.
So loss on fire in P&L account, do you debit it or do you deduct it? Or sorry, do you debit it or credit it? In P&L account,
Loss by fire is a extraordinary item, no?
yes, it's extraordinary item, but while writing the P&L account, you don't separate it. You just write it as a expenses only or loss only. While preparing the P&L account, you just write it as in the debit side, right? Because of that, your profit will decrease.
Yeah.
Right? We don't want any extraordinary items. You would have deducted it. Now you're gonna add it back.
That's how we add, yeah.
Yes, loss on fire. So previously you deducted, now you added, plus and minus gone. Effect is gone. Now insurance received. When you received the insurance, previously you would have written in the income side, right?
Yes.
As a gain. Now you don't want it. So previously you would have added it. Now you have to deduct it.
Deducted.
Insurance received. Okay. Then this is 2,000. Now this part, income tax refund. Okay. Now where you are paying the where you are from where you are paying the tax, from which account you are paying the tax?
Provision.
Provision for tax. From no, how you are creating the provision, from where you are taking the money?
P&L
P&L.
account.
So ultimately provision for tax is a dummy account which we are using, but ultimately money is coming from P&L account only, right?
Yes.
So we thought we have to pay income tax 50,000, like no, but income tax is only 45,000, so that's why they have given refund, like they have given back to us. So previously extra debited, right? Previously we debited 50,000. Okay, so now we need to give back to the P&L account. It's like we took more money from the P&L account. Now we need to give back to the P&L account. So anyway, whenever you get an income tax refund, you will write it on the income side as a income. Now you need to take it out, so add it, income tax refund. Then finally you will get net profit before tax and extraordinary items. So from there you need to start. So more than this there won't be any much adjustments. Okay, yes, of course we need to do the questions.
Can
There
you-
are some, yeah,
Can you please repeat why income tax refunded is added back?
because if you get an income tax refund, like one simple answer will be income. When you get an income tax refund, you will write in the P&L account credit side. Okay.
Yes, sir.
So why I am writing in the credit side? Because when you have taken more money from the P&L account, your profits has been decreased, right? Tax is 45,000 only, but you took 50,000. Okay, you took more money, because of that our profits decreased. Now when you get a refund, immediately you are going to increase your profits. Okay, you are going to increase your profits. But what we want is there should not be any tax only. There should not be any tax only. That's why here we already taken out the tax. You understand? We already taken out the tax. So
Yes.
there should not be any items. There should not be a deduction of tax also. There should not be any addition of the tax also. So you already taken out, let's just say they deducted 50,000. So now you added 50,000 because of this, right here. Yeah. Now, so they deducted 50. Now you added 50. Can I say the tax is gone from our account? So the tax, there is no tax in for us, right? Because we want a net profit before tax. So what did we do? We already deducted we took out the entire tax part. If you took the entire tax part, then you took the refund part also out, right? If you are taking the tax part out, you should take the refund part also out. So when you got the refund, they would have written in the income side. That means they would have added to the, sorry, here this is not add, actually this is deduct. So when you got the refund, they would have added to the profit. Now we should deduct it. Understood?
Yes, sir.
Okay.
Yes, sir.
So insurance refund they would have considered as an income, and then they would have written on the credit side of the P&L account. Because of that your profits has been increasing. But again, we don't want any tax items, so we want to delete it. So they would have added it. So now we are deducting it. Okay. See, because if you are deducting the provision if you are deducting the provision for tax, or if you are deleting the provision for tax, then delete the tax refund also, because should not be any kind of tax element. There should not be tax only. Okay. Now that's it. This is the most of the portion. Still we have some portion where we have to discuss questions and then do it. Okay, so first thing, whenever you are doing, this is the important one where most of the times we may get wrong. What is the starting point? Did they give surplus in the question, or did they give profit after tax in the question? Okay, so finding this as a correct is the one of the working note. This working note number 1 plays a major role. Remaining is a format. So net profit before tax and extraordinary item, this is the only thing which you need to find properly. Remaining is just following the format only. Understood? Okay.
Yes, sir.
next we are going to complete some kind of question, some big questions. We'll take like 5 or 6 questions and then complete this chapter. See, if you go from ICSI book, they just given the what do you say, if you see the ICSI book, they have given what is the format, they have mentioned, they have explained the basic meanings of all these things, and then they have done 3 or 4 problems, end of the chapter. Okay, but I don't think so in the exam they are not going to ask this simple. Like if you see, there is not even one big adjustments, very small adjustments are there. Yeah, and one more thing which we need to discuss about is depreciation part. We need to discuss about the accumulated depreciation. We need to discuss about how do we get profit on sale, loss on sale. So mostly about the depreciation chapter we need to discuss, and a little bit about this working capital changes. So this we will discuss while doing the questions only. Then you will get a full clarity. Cash flow statement will be done in 1 or 2 classes. This cash flow statement will be done, and then you guys can do some past question paper as a homework, and then we can complete this cash flow statement. Then we will move on to the some other chapter. Okay.
Okay, sir.
Yeah, bye. Thank you.
Thank you, sir.